Hi, this is Zak Mir, editor of Spreadbet Magazine, with a look at Gulf Keystone, the Iraq-focused oil and gas explorer, in the wake of recent share price weakness and the Competent Persons Report and associated working capital deficit worries. The situation on the daily chart is that we are in the aftermath of a Head and Shoulders breakdown that was flagged by myself early last month. Neckline support was around £1.65. That was broken in early February. We then had a failure just below that neckline, the black line here, towards £1.65. And really after that, the shares were blocked by the 20-day moving average shown in grey. That's now at £1.38. And the gap down last week was severe, to say the least. What is worrying in the near term is the way that even on the dead cat bounce from below 100 pence initially, we failed at £1.27, and that was the former 2013 support zone. So normally when you see a stock or market fail exactly or almost exactly at previous support, that is a bear signal. Obviously, we've also had this unfilled gap to the downside, which indicates a momentum there for the bears, in favor of the bears. Looking at the RSI window also, we've had the RSI below neutral 50 for most of 2014, so a very negative situation there. The final negative in terms of the daily chart credentials, one can say, is the way that we went down to oversold RSI levels towards 15, bounced back to 30, and then we're back down again. So that really does look as though there is negativity there over and above the way that the key 200-day moving average now at 168 has also started to decline. So everything looking rather negative. You could say that this is perhaps a selling climax, the bottom of the move, and I would go along with that. But really, even if you were thinking of bargain hunting these shares, you'd want to get back above probably the 10-day moving average level. That's £1.24, and that's trailing behind the price action at the moment. So we're probably still a week or two away from a sustained or sustainable rebound for this stock. In terms of the fundamentals, I think the situation here has been very negative for a while anyway. We had the director's share sale last year, multi-million pound share sale in April. The peak for the stock was back in September on the Excalibur victory, but that seems to be something of a Pyrrhic affair. Really, that was a sort of a buying climax, which turned out to be a bull trap rather than the start of any new constructive phase for the company. It's as if really that was already factored in as being an event that should have been won, and apart from the bear squeeze ahead of it, there was not really any sort of substance in terms of the fundamentals. So therefore, really, the outlook here is that below 2013 support, £1.26, one would be looking for a retest of 2011 support, which was 87 pence. We've just done that today, but back down there, and really the stock has to hold that 3-year support. If it doesn't do that, we could get back to something which is a rather negative scenario, perhaps going back down towards the 50 pence level over the rest of this year. But at least for now, a small respite for the bulls, for the fans of this stock, and one would go with that in terms of near-term stability. But you can't really pretend that this is a situation where the bargain hunters have an argument to buy just yet. That's it from me. See you again next time.